What if a single AI prompt could now replace 87% of what a $300,000 M&A analyst does in minutes, not weeks or months? No spreadsheets, no VAs, no guesswork, just fundable, high-quality deals handed to you 24/7, all for free. It's a precision-built acquisition prompt, battle-tested and engineered by real acquisition professionals to turn hundreds of hours of grunt work into minutes of investor-grade clarity, all before you've even made coffee. And it doesn't assist, it replaces. So welcome to the end of manual deal analysis and the beginnings of your unfair advantage. Hi, I'm John, and welcome to Deal Founders, the new U.S. gold standard for serious buyers who want to acquire profitable businesses without burning years or capital trying to figure it out all alone. Today, I'm giving you the God Mode AI acquisition prompt for free. And this isn't just a shortcut. It's a system used by real deal makers behind closed doors. And we've upgraded every single layer. Advanced screening logic, the tight buy box filtering. Smart valuation formulas based on weighted cash flow. SBA compliant capital stack modeling. Built-in risk detection and negotiation queues. And drop this prompt into ChatGPT or Claude, and you've effectively hired a 25-year M&A expert who works for free. And here's exactly what it delivers. It screens listings using investor-grade filters. It writes acquisition memos like a PE analyst. It calculates valuation using real-world deal logic, and it models 3 SBA-friendly capital stack options, and it flags deal killers before they cost you time or money. It's clarity, speed, leverage, instantly. And in just a moment, I'm going to walk you through the exact structure of the prompt, how it screens, how it values, how it models the capital stack, and how it flags risks and gives you questions for due diligence. And you don't need to reinvent anything. We've already engineered the entire prompt for you. So now if you want your AI to think like a seasoned acquisition professional, you just have to train it like one. And it starts with how you define your buy box. And that's why step 1 is all about precision filtering. We don't ask AI to find me a good business. We load it with investor-grade criteria and let it go to work. Now, let me walk you through full 5-stage AI engine and how it works step by step. Stage 1, advanced deal screening. We load the AI with a very specific buy box, far beyond generic prompts. So let's get into it. Write exactly the following prompt. You are acting as an experienced M&A analyst with 20 plus years of deal evaluation experience, trained in private equity level screening logic, SBA financing structures, and acquisition risk detection. I want you to identify acquisition targets that match the following criteria. This is our strict buy box for screening high quality, recession-resistant businesses. Screening filters only show businesses that meet all the following. Number 1, annual revenue $500,000 to $5 million. And if you're seeing mid-market opportunities, you may expand up to $10 million. Number 2, EBITDA margin between 15% and 35%. This is our golden cash flow ratio zone. Businesses with enough margin for debt service, buffer, and reinvestment. Number 3, industry. It must be in recession-resistant verticals, such as not every business is worth buying. Some are fragile, trend-driven, or just too risky to scale. And that's why when we build our AI deal engine, we tell it to focus on industries that are built to survive and thrive, even during a downturn. And we call this our recession-resistant buy box, and it includes both traditional and online business models. Let's start with the brick and mortar side. Traditional businesses we love include commercial cleaning and janitorial services, industrial maintenance and equipment servicing, healthcare support and compliance providers, elder care, essential home services or staffing agencies, and B2B field service companies like HVAC, logistics, or niche construction. And why? Because they're essential, they're sticky, and their customers come back month after month. Now, what about the digital side? Here's where online models shine, but only if they meet the right criteria. We target SaaS businesses with stable monthly recurring revenue and less than 5% churn, B2B agencies, marketing, compliance, or systems based with retainer clients, content sites, but only if they're monetized through memberships or a diverse affiliate base, digital product businesses like info products or course platforms with evergreen content and low refund rates, Amazon FBA or e-commerce brands only if SKU concentration is low and margins are over 20%. Subscription boxes with churn under 10% and outsourced fulfillment. Marketplaces or platforms if there's proven repeat behavior or recurring usage. Now, just as important as what we like is what we avoid. So stay away from one-time sale e-commerce with heavy paid traffic dependencies, YouTube influencer or creator-based businesses, anything in crypto, NFTs, or unregulated speculation, AI tools with no paying customers, or mobile apps that don't generate subscription revenue. And here's the bottom line. Whether it's a cleaning company or a cloud-based CRM, the model must be durable. And that means, number one, recurring revenue or clear repeat purchase behavior. Number two, loyal customers or low churn. Number three, and at least 3 years of stable or improving net income. 4, revenue model. Prioritize recurring revenue, retainer clients, or multi-year service contracts. Project-based income is acceptable only if repeatability is strong. Number 5, leadership team. It must have a general manager or leadership team already in place. We're not looking to buy ourselves a job. Number 6, customer concentration. No single customer should represent more than 20% of total revenue. A diversified client base is critical for SBA compliance and risk mitigation. 7, profitability trend. Business should show a positive or stable profitability trend over the last 3 years, even if growth is modest. AI output format. Return in this structure. For each deal that qualifies, return the following in a table or bullet format. Business name, if public. Industry or sector. Location by state and region. Revenue, TTM. EBITDA, TTM. EBITDA margin and percentage. Owner involvement, low, medium, and high. Recurring revenue model, yes, no, with a brief description. Existing GM or team in place, a yes or no. Customer concentration, the percentage of revenue from top customers. 3-year profitability trend, is it improving, flat, or declining? Buy box fit confidence score, a 1 through 10 with 1-sentence justification. Flagged notes, risks, if any, and only show the best fit businesses ranked by confidence and strength of margin plus team plus industry combo. End of prompt. Stage 2, professional acquisition memo. Now that you've found a deal that fits your buy box, the next move is what separates amateurs from acquisition pros. You need to know what you're looking at and how to present it clearly, and that's where stage 2 comes in. We ask AI to generate professional acquisition memos, the kind of deal brief that a private equity analyst would spend hours completing. But now, with one command, you get a crisp executive summary, the industry outlook and competitive landscape, clear growth opportunities post-acquisition, a risk review with built-in mitigation thinking, a precise valuation range using your cash flow inputs, a smart suggested offer, typically 15 to 20% under fair market value, and 3 strategic broker questions to uncover negotiation leverage, all created in under a minute. And here's the exact prompt that you should give your AI. Copy, paste, and run this inside ChatGPT or Claude right after identifying a high potential listing. Act as a senior M&A analyst. I'll give you a business listing, and I want you to create a full acquisition memo with the following structure. Number 1, executive summary. Revenue, SDE, EBITDA, margin, asking price, owner involvement, location. Number 2, industry, trajectory, and a snapshot of the competitive landscape. Number 3, growth opportunities the buyer could pursue. Number 4, risk review with red flags and how to mitigate them. Number 5, valuation range based on weighted historical SDE 50, 30, 20, and an appropriate multiple owner-operated versus GM-led. Number 6, a suggested offer price 15 to 20% below midpoint of FMV. 7, 3 strategic questions to ask the broker or seller that reveal hidden deal quality or negotiation leverage. Present the memo as if I'm briefing an investment committee on this opportunity. Make it smart, structured, and strategic. Want to go pro level? Add this line at the end. Give the memo a confidence score from 1 to 10 based on recurring revenue, margin strength, documentation quality, and industry stability. End of prompt. Stage 3, weighted valuation engine. All right, now it's time to answer the million-dollar question. What's this business actually worth, and what should you offer? This is where the math meets real-world risk, and where our AI stops being a data assistant and becomes a strategic deal partner. And we're going to plug in 3 years of historical earnings, either SDE or EBITDA, and have AI calculate a weighted average that favors the most recent year. Why? Because the last year tells us the most about what you're actually buying today. And here's how it works. AI gives 50% weight to the most recent year, 30% to the year before, and then 20% to the third year that gives us a smart average where we built in trend sensitivity. Then it selects the right multiple based on deal structure, 2 to 2.5 times for owner-operated businesses, 3 to 4 times if there's a general manager or team in place, and finally it flags red flags like margin compression, customer churn, or too much owner dependence, and gives you a safe offer recommendation, usually 15 to 20% below market. And you're not just getting a number, you're getting the why behind the number. Okay, and now here is the exact prompt that you should give your AI, the prompt. Act as a private equity valuation analyst. Based on the 3 years of SDE or EBITDA data that I'll provide, calculate a weighted average using 50% for the most recent year, 30% for the second, and 20% for the third. Then select an appropriate valuation multiple, 2 to 2.5 times for owner-operated businesses, 3 to 4 times for companies with a GM or low owner dependency. Calculate the fair market value range and explain your rationale and suggest smart starting offers 15 to 20% below midpoint FMV. Also flag any red flags based on the data such as margin compression, revenue decline, customer concentration, heavy owner involvement, inventory or working capital risks. Present all numbers clearly and finish with a 1 to 10 confidence score based on deal fundamentals. End of prompt. This is professional level valuation in seconds. No spreadsheet, no guesswork, no wasted time. Now coming up next, we'll take that valuation and plug it into 3 real-world capital stack models to show exactly how you can fund the deal even with 0 money down. Stage 4, capital stack modeling, SBA compliant. Welcome to the part of the process where most buyers either overpay or completely freeze. And we're talking about deal financing structure. And this is where it either gets funded or falls apart. And that's why step 4 is all about capital stack modeling. And we use AI to do it like a pro. With just one prompt, your AI can now build smart, SBA-compliant capital stacks the same way real M&A advisors model them for 7- and 8-figure clients. But first, let's set expectations. For this video, we're going to walk through 3 foundational capital stack structures. They're beginner-friendly, SBA-compliant, and real-world fundable. And you could take these straight to a lender today. But here's the truth. Inside the Deal Founders Accelerator, we go way deeper than this. Our members learn how to model capital stacks based on deal size and risk profile, buyer balance sheet and liquidity, seller preferences and earnout flexibility, strategic equity partner appetite, post-close cash flow requirements, and the bank's collateral and lending tolerance. From rollovers to seller earnouts, mezzanine debt, working capital buffers, and strategic co-investment layers, we teach the same advanced structuring that PE firms use behind the scenes. But here, let's start with the 3 foundational models that your AI can generate in under a minute. So scenario A, 0 cash down with seller note. Why it works? This is the classic no money down acquisition. It's lean, fundable, and lender compliant, assuming that the seller trusts you and the numbers support it. Scenario B, buyer cash in. There's no seller involvement. And why it works? If you have some capital and want full control, this is clean and simple. You retain 100% equity and the seller exits cleanly. In scenario C, silent equity partner. And why it works? It's perfect if you want to de-risk the deal without using personal capital. You still keep 90% ownership and gain a strategic backer or funding partner. And what the AI calculates for you, for each of these 3 scenarios, AI instantly delivers total cash required at close, monthly SBA debt service based on a 10-year amortization at around 10% interest, net monthly cash flow after debt, year 1 cash on cash return, plus a concise pitch script for sellers and lenders that explains the structure clearly. And this is real capital stack modeling, not napkin math, no spreadsheets, no financial advisor, just clean, structured deal logic in seconds. Here's the exact AI prompt to use. Act as a senior M&A deal structurer. Based on the total purchase price, I provide Model 3 SBA compliant financing options. Scenario A, 90% SBA loan, 10% seller note on full standby, no payments for 24 months, $0 buyer equity. Scenario B, 90% SBA loan, 10% buyer equity, no seller note or investor equity. Scenario C, 80% SBA loan, 10% seller note, 10% silent equity partner. For each structure, calculate cash required at close, monthly debt service, 10-year term, 10% interest. Estimate net monthly business cash flow, first year cash on cash return, a simple pitch script to use with lenders and sellers, and finish with a recommendation on which scenario best fits a buyer with limited capital but strong credit and operational readiness. End of prompt. This kind of modeling used to take hours or cost you thousands in advisor fees, and now you get full stack visibility in under 60 seconds. Modeled by AI, guided by real-world logic, and ready for lender review. Whether you've got capital, none at all, or you want to bring in a strategic backer, this one prompt gives you the leverage, clarity, and confidence to structure deals that actually close. The Stage 5 risk scanner and diligence checklist. And now it's time for the final layer, and it might be the most important of them all. Even a profitable business can become a disaster if you miss the red flags. So in this next step, we activate your AI's risk detection layer, like a virtual CFO, lender, and legal advisor all rolled into one. It doesn't just screen for numbers, it pressure tests the entire deal before you waste time on a bad LOI or chase a business that can't get financed. And here's what the AI evaluates. Working capital needs, like does this business need heavy upfront cash to operate or scale? Or seasonality and revenue cycles, like are there income cliffs that you're just not seeing? DSCR, debt service coverage ratio, remember, is there at least 1.25 times coverage for lender approval? Owner dependence, can this business run without the seller, or are you buying yourself a job? Customer concentration risk, does one client account for more than 20% of revenue? SBA deal killer triggers like unverified tax returns, no third-party financials, or related party lease conflicts. Then, and this is key, the AI generates a targeted checklist of smart follow-up questions like, ask the seller how long the GM has been in place. Clarify if contracts are assignable under SBA requirements. Request a monthly revenue breakdown to confirm seasonality exposure. It's like having a deal advisory board whispering in your ear, telling you exactly what to ask next and what landmines to watch for. Okay, here we go again. This is the exact prompt to use. Act as a buy-side M&A advisor conducting preliminary diligence. Based on this business summary and structure, evaluate working capital adequacy, seasonality or cash flow gaps, debt service coverage ratio, DSCR, flag it if below 1.25 times, customer concentration or seller reliance, SBA financing red flags, for example, no third-party financials, lease issues, single customer risks. Output a list of, number one, key risks with severity rating from high, medium, and low. Number two, follow-up questions for seller, broker, or lender. Number three, red flag summary with recommendation to proceed, pause, or walk away. End of prompt. Okay, so there you have it. A full 5-step AI framework, screening, memo building, valuation, financing, and risk scanning, all modeled with pro-level logic and delivered in minutes instead of weeks. Okay, so here's what to do now. Grab the full God mode prompt, and it's linked below. It's free to use and modify. Customize the buy box to your industry, whether you're targeting HVAC, staffing, or janitorial services, or scaling in SaaS, digital products, or subscription e-com. Run the deals through it and tweak the logic based on what lenders or brokers send back. And we've already shared checklists and calculators in the free Business Acquisition Masterclass here on YouTube. The link's in the description below. Make sure to check that video out. Amazing free value being given right there. And you can download them now and start structuring deals like a pro. And if this video opened your eyes and you're serious about making your first acquisition, then it's time to stop learning in circles and start executing with precision. The Deal Founders Accelerator is our flagship execution program built for strategic buyers who want to close real deals without wasting months guessing. And we help you find, fund, and close acquisitions with confidence and speed, whether you're buying traditional service companies or digital businesses. And inside, you'll unlock over 20 hours of elite step-by-step acquisition training covering both online and offline deals, private access to SBA lenders, M&A professionals, and capital advisors who guide you through real closings. A serious buyer community where capital, partnerships, and deals are shared daily, and the exact tools, checklists, and legal templates used by top operators all ready to deploy This is the infrastructure private equity firms pay hundreds of thousands to build, and it's now available to individual buyers like you. So click the link, join the movement, and let's get your first deal done the right way. And not ready to join just yet? No problem. Just drop a comment if you want to see one of our advisory board experts walk through this entire process, sourcing to capital stack on a real deal live on the channel. Like, subscribe, and turn on notifications because we're building the #1 channel for acquisition entrepreneurs. This isn't theory. This is Deal Founders, and you're just getting started.